right, welcome everyone. This is Kevin LaRocca, and what I thought I'd do here is put together just a really short video on how I trade the markets, how I look at the markets. I call it unconventional, so this is basically going to be an introduction to my unconventional trading strategies and methods. If you've been following me on my live show, I have been getting a lot of questions, and it is different from what you're used to because when you go to my live show and you look at my charts, you don't really see anything on my charts. So I know you're used to seeing a lot of lines and horizontal lines, vertical lines. You're seeing all kinds of different kind of indicators, but and I want to touch upon that and why it's something I don't use, and I do look at markets a little bit differently than most people do, and I want to touch upon that. And I feel that the best way to trade is using the type of tools that I've discovered over these last 40 years. Most everything was discovered back in the late 80s. I call them behavioral patterns, but I was also introduced to Einstein, an Einstein formula. So I'm going to talk a little bit about that. And then down the road, I discovered something called crystal ball. And we'll be talking a little bit about that as well. So let's get started here. Let's get into it. But I know some of you may be new to trading. You've never traded in your life, and I see that a lot. So I am going to go through some of kind of the basics here. For those that have been trading for a while, just bear with me. I know this is really fun. This is just fundamental stuff, right? So I want to make sure that everybody is kind of clear on exactly, how do people trade? I mean, these professional traders, what do they use when they trade? I mean, because you've got hedge fund managers and, you got people trading mutual funds. And, of course, you have your individual traders. You have your swing traders. I mean, everybody's kind of looking at different time frames and trading different time frames, and depending on what kind of trader you want to be. In most cases, most people want to do this for a living or at least make a fairly nice little part-time income. And in cases like that, most of the time you're going to be a very short-term trader, usually in and out of the market. They call it scalping, more so than being a trader that's going to be buying, a set of stocks and holding it for, 6, 7, maybe even longer months in order to make some gains. But that's not necessarily a bad strategy. But in order to make any decent money, you really have to put a lot of size on and be willing to hold that for an extended period of time. So anyway, let's just get into some of the basic stuffs here, and then we'll start looking specifically at how I look at the markets and some of the trading strategies and methods that I use. So basically, there are really two types of traders, and those traders usually are going to be using two different tools because everything really is a trading tool. And first, we have the fundamental traders. They're looking at fundamental information. Then we have the technical traders or technical analysis. Fundamental traders are really mostly those that are buying and hold a position for an extended period of time. Or they may be a hedger where they are trying to purchase grain to hedge their price and to lock in their price. So they're going to be looking at things of it on stocks. You're going to be looking at earnings. You're going to be looking at any kind of changes in management, any kind of quarterly reports, those types of things. Those are all going to be fundamentals, could be weather related, whatever the case may be. And that's where a trader focuses on company specific or news events to determine whether to buy or sell. Now, trading on fundamentals is more closely associated with a buy and hold strategy rather than short-term trading. What most people are doing, and most people that are looking to make some extra income or even do this for a full-time living, they're going to be more bent towards technical analysis. Now, keep in mind also those that are using fundamental analysis are also using technical analysis to get in and get out of the market, or at least give them a reference of where the optimal point would be to enter the market, as far as based on the kind of indicators and whatever the fundamentals are shown at that time. But most of your short-term traders, if not all, are going to be relying technical analysis. So basically, technical analysis is more of a numbers-driven approach to decision making. It assumes that current price reflects market forces like supply and demand. Common technical indicators include, and so there's thousands of indicators, but some of the ones you may be familiar with: moving averages, trend lines, momentum studies, Bollinger Bands, etc. And like I said, there are thousands of different types of technical tools that people use to give them a reference or even an indication of where to enter the market, all right, how to put a position on, either buying it or selling it. This is what we call a bar chart. Now, those, once again, I know a lot of you are traders, so just bear with me. Some have never even seen a bar chart, nor even understand what a candlestick is. And so basically, this is going to be the S&P 500. This could easily be a chart of treasury bonds. It could be a stock. They're all going to look very similar to this in the sense that you're going to have red bars and green bars. And what you're seeing here is you're seeing buyers and sellers. So seeing all these are individual days. If you see a green bar, basically what that means is that the market opened and it closed higher than it's open, so it's going to be a green bar, so it is up off of its opening. And if it's a red bar, that means it opened and closed lower than its opening price. That would be a red bar. So obviously green bars indicate that the market is wanting to go up or has gone up, and green bar and red bars indicating the market's going down or wants to go down. So let's look a little bit more in depth on each one of these candlestick bars. So as I mentioned, you have on every day, you're going to have an opening price, all right, as you can see here, and you're also going to have a closing price, right? So that's a green bar, so that's basically an up bar, or that means that there was a lot of buy-in during the day. But you also have these little wicks down here. They call them wicks. And this means that the prices, after it opened, went down here, all right, and hit a low. Didn't hold it, and then went way up here, hit a high, and pulled back off of the high, and it closed here. So you see the wicks are showing the extremes of the day's action, all right? And this is important. All this information is important because it gives us an idea of what's going on in the market. Are we seeing price rejection, or are we seeing the market just like super strong and it's just buying all day long, you know, where you basically open on the low and you close on the high, and you will see that at some point. But usually you're going to get some sort of wicks, and each one of these wicks and these formations and how big the wicks are does give us an idea of kind of what's going on internally in terms of what they're thinking about where prices are going. All right, so that is going to be an up bar, and it's just the opposite to a down bar. If you come over here and we look at our sell and down bar over here on the red, it's the same thing. So you open up here, you know, you had a high, it went up here, but then it came back down, and then you have a close here, we're close here, but it did go all the way down to this low and bounced back up. But it opened here and closed here, so that means the overall action for the day was down. And this right here is called the body of the candle. So you have the body of the candle, right, and then you have the wicks, all right? So in this case, you know, you had a green body, and over here you had a red body, all right, for a down day. Now, you're going to get some days, and it's not often, but they do happen. They're called neutral days, where basically it's pretty much going to open and close at the same price. So market can't really decide what it's going to do. You'll see this a lot of times when the market is trying to decide whether it's going to continue to go up or not. So you're really a lot of supply and demand. Buyers and sellers are pretty much even. Haven't really broken out on which way prices are going to go. So we're pretty much at a stalemate here. So you have your opening, then maybe you went up to the high, and then it came all the way down to the low, and then it come back up, and then it closed here. You know, so they rejected prices going higher, and they rejected prices going lower. And so this is kind of a neutral bar. So you will see those kind of bars. So those are basically the three kind of bars that you're going to be seeing when you're trading. All right, so we talked about trading tools and indicators. So the most common trading tools that you're going to be exposed to, particularly if you're a new trader, you're going to hear people talk about moving averages and stochastics and relevant strength and Bollinger Bands and Gann lines and Fibonacci retracements. There's hundreds and hundreds of different kind of indicators, all right? And I'll show you an example of what that looks like in the chart. But every single one of these is supposed to give us some sort of indication of not only the direction of the market, but maybe the strengths of the market. Is the market strong? Is the market weak? Has it extended beyond what is normally expected for its particular price extension? So Bollinger Band, something if it goes, 2% above, or what is it? Yeah, 2% extension of price, then they think that the price is going to come back down because it's gone too far, right? So it's gone up too far, it's gone down too far. So they're expecting it to pull back. And of course, you've got Gann and Fibonacci, and you really start to get into some interesting ways of looking at the market. So every single one of these tells us a little bit different, something different about the market. And this is what most people commonly use. They're going to be using some sort of indicator like this. And then it's something that you won't see in my charts, and I'll touch on why that is here in a minute. So this is kind of, once again, here's a bar chart again, right? So we have the red bars and we have the green bars, right? And then these lines, like these red lines up here, that's a Bollinger Band, right? So you have a 2% like deviation. The expectation will be that it's going to hit this red line, it's going to pull back down, or if it hits this green line, it's extended too far and it's going to bounce back up. And this is kind of your medium point here where you expect the price to at least come back to. That's one. And then of course you have, simple moving averages, and you also have something down here called stochastics, where, if it gets over 80%, quote, they think it's overbought, or if it gets down below 20%, it's, quote, oversold. So if it's overbought, they would expect prices to start coming back down, and prices are oversold, quote, oversold, they expect prices to go back up, all right? But just briefly looking at that, you can see that one of the problems that you have with indicators is it's a mathematical based formula, and those parameters, all of them can be changed. So with stochastics, you may be using a 20-10-2 or 20-10-3 or an 80-20, 80-20, 10-3, 80%. Maybe somebody uses 75%. Maybe somebody uses 25% in terms of indicating what is considered oversold or overbought. But the problem with this, and we're going to touch on this, is that these are modifiable numbers. You never come up with an exact number because they're always changing, right? So, and also, you're always lagging price with these indicators. So you're really behind the 8 ball when you're looking at an indicator, because you don't even need the indicator. You can see prices are going up. You don't need a moving average to tell you that it's going up. You don't need a Bollinger Band, to tell you that it's going up, or maybe it's gonna, you're expecting it to bounce, whatever the case might be. If it's gonna bounce, it's gonna pull back. If it does, then it's gonna keep going back up. So these are all, once again, these are all what we call lagging indicators, and they're showing you what prices were doing. They're not what prices are going to do. And I can promise you there's no set of indicators that will continue to hold up over an extended period of time. In fact, our studies have shown that we can't even get an indicator to be effective carrying out 30 days. And then the other thing that you have is that if you do find a nice set of indicators that seem to work for a given period of time for a particular market, let's say the S&P 500, and that's the ES, which is the E-mini S&P, if I try to use these same sort of parameters and these same numbers, and I tried to trade treasury bonds or maybe a particular stock, Tesla or whatever the case may be, it just doesn't work. Okay, so they're definitely not universal. And the key is we want to find something that's closer to the real-time price action, but also something that's universal, right? We want something that we can rely upon to use as a tool, because just like building a house, you want to make sure you're using the right tools, right? You don't want to go in there with the cheap tools. So if you're a professional, you're going to use good quality tools, and that's going to be the same thing when it comes to trading. We want to know that the tools that we're using that are going to be reliable and are going to be holding up. So that is what they look like on the chart. So kind of touched on this a little bit. Problem with traditional technical analysis is the biggest problem with technical analysis, or what we call indicators, is they are based on mathematical equations, and the right parameters and input values are never static but constantly changing. And the problem with anything like that is you don't know it changed until after the fact. You don't know it's changed during the fact. You know it's changed after the fact, and by then it's too late. So that's the biggest issue that I have with indicators. Now, some people will say, well, I like my indicators, they give me a reference point, but that's really all they're doing is they're giving you a reference point. But they're giving you a reference point with lag time behind it. And like I said, you can look at a chart and see whether the market's going up or down. You don't need some sort of indicator on there to tell you the market's going up or going down. I mean, it's, you ask a child, kids are pretty good traders because they just look at the chart and say, oh, it's going up, and yeah, it goes up, and going down, goes down. That's better, that's closer to the action than some sort of indicator that's based on price action that's lagging in price. So once again, technical indicators lag price. Technical indicators are not reliable on their own, so they are more subjective, and that's the other thing. So, if you have a particular indicator, and this is something that I see a lot of people do, is they take an indicator, let's say it's something like, say a moving average, right? And the question is, well, can you make money just trading off of that moving average? And the answer is you cannot, because when the market goes sideways, what you'll see is that moving average line will start to flatten out, and so you just get chopped up, right? So what they do is they try to throw on another indicator. They're look for maybe overbought, oversold, or they're look for channels. I mean, and once again, when I'm talking about channels, it's using an indicator to identify a channel. So, but the problem with that is that if that one indicator, the moving average, is not going to be profitable for you, if it's not going to work for you on its own, why would you want another indicator that's not going to work on its own, and putting them both together thinking that you're going to have, a better probability of having winning trades? I mean, I use the analogy of, you're working on a car, and for some reason one of your spark plugs dies, and so you go out and you get another dead spark plug and put it in your engine, thinking it's going to start to run better. And it's the same with indicators. So any indicator that you're using should be able to two things, and it has to meet two criteria as far as I'm concerned, and that is it has to be universal, right? That's number one. It has to definitely be universal. So that means whatever that tool that I'm using, it has to be able to be effective in all markets. Number one. Number two is it's not subjective. It's black and white. It either is or is not. There's no guesswork. There's no price going above and below your buy point. It's either yes, it's a buy right now, or yes, it's a sell right now. And it's not subjective. It's very clear cut whether you're going to buy or sell in the market. Okay, so we want that. We also want it to be universal. I wanted to see whatever that tool is I'm using, I wanted to see I should be able to take it and use it with any other market and not have to make any changes to it, right? So the only way to do that is you have to find something that doesn't have parameters. Back in the 80s, that's one of the biggest things as I was looking for, is try to find something that had the least amount of inputs that you had to change, right? So if you have something that has several inputs or parameters, then the likelihood is it wasn't going to hold up. But if you could find something that has no parameters, basically it's just pretty much black and white, right? Then that is going to be the best thing that you can find when it comes to trading the markets. Now, once again, nothing guarantees you success, but once again, like everything else, these are tools. So if I'm going to use a tool, I want to make sure I'm using the best tool. And I definitely want to use a tool that doesn't have any parameters to it, because not only is it easy to go back test, but it gives me very clear indication which way I want to be in the market. All right, so indicators are not reliable on their own, so they're more subjective. They're not universal, as we mentioned. No one indicator, same input values, works in all markets. And then all of these indicators are curve fitted. So typically what somebody's going to do, if they're using these indicators, they're going to take their data, and let's say they have 20 years of data, and what they're going to do is they're going to run it back for the last 10 years, and they're going to find these ideal numbers to use for moving average. They found great 21-day moving average works great for the S&P 500. Then they come in, they use Bollinger Band, and they say maybe 2.2 deviation is absolutely the best, blah, blah, blah. And then the idea is that, well, if it worked like that great in the past, it's going to work that great in the future, and it doesn't hold up. All our studies, when we used to do that, we spent a lot of money on checking out these indicators. We couldn't get anything to hold up even 30 days into the future. The parameters would change. And then the question is, when do they change? And the problem is you don't ever know that until after the fact. So, we quickly got away after studying indicators. We realized that there had to be, if you're going to trade and you're going to make money at it, there's got to be something better than indicators, right? There has to be something that's more universal and gives us a better indication of what's going to happen. Because my belief is that people are people, right? And so people are going to behave, okay, under certain conditions the same way over and over again. The key is we can find those conditions in the market, then we can take advantage of that because we know the condition is right for a particular reaction. And so let's go and let's see if we can't find those situations by looking at our price structure. Like, remember, we're going back and looking at those candles, right? Those open, high, low, close relationships. And let's see if we can't find some really reliable patterns that, I see them show up in the S&P 500. I see them show up in treasury bonds. I see them showing up in stocks. I see them showing up in cryptos. I see them showing up in everything, right? If you see that, then you've got a really good indication, right, of which way the market's going to go, because people start to show their hand under certain conditions, right? Certain situations that happen in the market, and so that's really what we're looking at. We're looking for basically that smoke in the fire, and when we see the smoke, then typically there's going to be fire. So we're looking for the smoke in the charts. So yes, there is a better solution. And so for me, the better solution is what I call predictive modeling. Now, predictive modeling, it's also called predictive analysis. It's a process that seeks to predict future events or outcomes by analyzing patterns. In this case, would be price patterns that are likely to forecast future results. The goal of predictive modeling is to answer the question based on known past behavior patterns, what is most likely to happen in the future. So what are behavioral patterns? They are predictable emotional reactions on a mass scale to a particular event. Once again, you see smoke, more than likely there's fire, right? Everybody knows that, and typically everybody's going to react the same way when they see smoke. That's what we're looking for. If we know what smoke is, then we can get an idea of what the reaction is going to be. So what are the advantages of behavioral patterns? First of all, there's no lag time, so we don't have to worry about it lagging the market. It's going to be as close as you can possibly get to what's going on in the right now in the market. There is not going to be any lag in terms of, well, that's what it was doing. No, this is what it is doing. And once again, when it comes to trading, the market's always going to be right. So you want to be in sync with the market, and this gets you in sync with the market because this basically says, hey, the market's going up. We see smoke. Market's going up, and you want to go with that flow. It works in all markets and conditions, so it doesn't matter if it's a market that's having a strong push up, or if it's starting to go sideways. Particularly when you're a short-term trader. When you're a short-term trader, we can take advantage of both markets. So these patterns you'll see do repeat themselves over and over again in different, not only time frames, but in markets that are not only having a sharp move up or down, right? They're trending, but also when the market consolidates, we're going to see that as well, to see the patterns still continuing to perform. They're non-subjective, so I don't have to guess. Is this pattern a buy or a short? Pattern, no. We know what the pattern is. It's either going to be a buy or short, so we don't have to worry about making that decision whether we're going to take a buy or short. And they can be quantified, measured with historical testing. It's something very difficult to do with indicators because a lot of times you don't see the action intraday of what's going on when it hits a particular line or a Bollinger Band or whatever, all you see a lot of times is the close. And the question is that, well, what you didn't see is the time that it went above and below that line 30 or 40 times during the day. And so what are you going to do? You have to wait till the end of the day to put on a position. And a lot of times it's too late, but yet your indicators shows that you would have sold at a higher price or bought at a lower price, but in reality, you wouldn't have been able to do that because you would have been chopped up. So once again, it's indicators can't give you that kind of reliable historical testing that we can with patterns. Okay, so let's talk about patterns. What do I mean by patterns? Now, these are just some examples. They're not necessarily patterns, but they're kind of patterns in the sense that we're looking at relationships. Once again, we're looking at 3, 4, 5, 6 bar patterns, okay, of what is the body of the candle doing in relationships to its wick. So is the wick lower on the downside? Is it higher on the downside, lower on the upside? And then we look at this relationship. So we'll go back and we'll look at, let's say, this particular pattern right here for the last, you have a 3-bar pattern going back, right? We have 2 green bars just evenly wicked in the middle, and then you have this real strong red bar to the downside, right, with smaller wicks kind of on both sides. To us, that indicates it's going to be a buy the next day. And so what we'll do is, and this could be a 5-minute bar, this could be a daily bar, this can be a monthly bar. It's giving an indication of what it's going to do during this particular time frame. Is the next bar going to be green or going to be red? And so what we do is we take this, we go in and we do this analysis. We find this, we say, hey, wow, this really looks good here for the S&P. Let me run it against the other markets, right? And if I see that I have a strong statistical probability that the next day is going to be up, then I've got a reliable pattern, right? If it's showing the same stats across the board, and that's something that I definitely want to, that's something I want to use as a tool in my trading because it's reliable, right? It's identifying some sort of smoke in the market right before something's going to happen, right? Right before there's going to be fire. So we're looking for these smoking patterns, and we want to see that they're going to work in different markets and different time frames. Okay, so this is basically what we just call like a 3-bar pattern. Like I said, they could be 4-bar patterns. Here's a 4-bar pattern, very similar to where we have a green and 2 reds, and then you have this really strong green bar here, right? But it's indicating, most people look at this and say, well, it's going to go up in the next bar, and the market's going to go up. But in reality, based on what we're seeing in the past, there's an indication that no, it's going to end up going back down again. And we see that short. And these are actual examples of some of the setups that we've been looking at. But these bars that you're seeing back over here, the wicks are going to be a big part of that, the size of the body of the candle and the color of the candle. So that we're going back and we're looking, and the computer is running the analysis and looking for these patterns: 2 days, 3 days, 4 days, 5 days, 6 days. You don't want to go too far, but typically max maybe four bars back that we have found is going to give us overall reliability. Now, when we're talking about tools, and this is going to be true for any tool, you have to have realistic expectations of what you can expect in terms of predictability. And I know a lot of people claim that they're 80%, 90%, but nobody can be 80, 90% all the time. It's just not realistic. Most good traders are probably going to be somewhere in between 65 and 75%, closer to 70%. Because what happens here is that's going to be about the maximum that you can squeeze out of the market reliably, because there's noise in the market. Noise are, unpredictable events like, some sort of major news event. Like, if there's a war breaks out or somebody gets shot, or, all of a sudden the Feds decide they're going to raise interest rates, right, just out of the blue. All of a sudden the market's going to react to that. That's noise. You can't predict that, all right? So we're not psychics here, so you can't predict that. And so you're going to see that in the market. So you have to be realistic of what you're going to expect. And if we can get in the 70 percentile, then we're pretty much maxed out. That is going to be our tool. That is a tool that's going to give me above average probabilities of being in the right direction, right? Doesn't guarantee that it's going to make money, remember, because we're talking about 70%. So 3 out of 10 trades, on average, are going to lose money. But that's the part of trading. You have to understand that trading is nothing but probabilities. You have to learn how to manage, of course, your profits, and you also have to really manage your losses too. It's like a business, right? You don't want more expenses than income. So it's the same thing with trading. It's something we really want to manage, those expenses. And then when we do have profits, we want to try to take advantage of that and squeeze what we can out of it. And we do that by looking at the set of patterns that are forming. And if we have several of them all forming at the same time, and we do layering of patterns, then that gives us a stronger indication of whether we can go ahead and adjust size. But all that stuff is something we teach in our packages. All right. So I call them behavioral patterns. Behavioral patterns are predictive. So once again, I'm just going to go through the scenario. It's just kind of common sense, but it's a good way of thinking about behavioral patterns and why not only we can predict, but you can predict. And once you understand what a behavioral pattern is, and it's like, aha, that definitely makes sense, right? So we use the example of the burning building, right? Where there's smoke, there's fire. So, if you're sitting in an office building and there's no smoke, then if you were to say, well, let's make a prediction here. How many people are going to be leaving at 6 o'clock? Or how many people are going to be leaving at 5 o'clock? Or how many people are going to be leaving at 5:05, right? It's like trading the markets, like what's going to happen over the next 5 minutes? Well, we don't know that, right? Because we're not seeing any smoke in here, but you put smoke in there, now you and I both can make a pretty high prediction that in the next 5 minutes or whatever, the majority of people are going to be leaving that building, right? We're predicting that based on the fact that we saw some smoke. Now, does that mean that 100% of the people are going to run out of this building? No, nobody can tell you that. There maybe somebody got stuck in there. Maybe somebody's going to try to be a hero and put out the fire, right? We can't say 100%. We can definitely say better than 50%, 60%, 70% people are going to be running out of that building, right? That's what we mean by behavioral patterns. So that's what we're looking for. Behavioral patterns are identifying the smoke. So we know when we see smoke, then we know we're going to see fire, and that gives an indication of what the masses are going to end up doing, whether they're going to be buying or whether they're going to be selling more. Okay, so we're going to talk about the core strategy. Now, the core strategy is part of one of our packages. We talk about it. We have 3 levels of packages, but for right now, let's just call it core. This is what we used when we started with binary pro strategies. And so the patterns are exactly the same. We call them the core because they are the foundation of the patterns that we use when we're trading. All right. And so with core, there's actually 4 different patterns that we use that are the basis of everything. And basically, we're going to talk about each one of those because each one of these patterns, they're hidden forces. So these hidden forces, they're hidden forces that influence and predict market price direction. Okay, so think of each one of these patterns as kind of like a hidden force, and some of them you won't even see on the charts. All right, and we'll talk about that. But that's the problem. A lot of times, people just looking at charts. There's other things to look at besides just charts, right? To get an idea of what are those hidden forces that I may not be seeing on the charts that may give me an indication of what's going to happen with the particular market that I'm trading. So basically, price movement is influenced from 4 different dimensions. All right. There's actually a 5th dimension, but that's not part of core. We'll talk about that 5th dimension in a little bit. But there's basically 4 different dimensions. Okay, and each dimension is expressed by its own unique behavioral pattern. So these 4 patterns influence a separate and unique characteristic of the present and future price direction. Once again, all pattern based, no indicators. So basically, we have 4 different dimensions. Now, the first dimension is the setup pattern. So if you've seen our charts, if you've been to the morning show and you're looking at the stocks, the indices, you see those little red and green carrots. Those are first dimensional setups. Okay, those are the first dimensional setup patterns. It doesn't mean that we take every single one of them, but it's beginning to show us that we're starting to get some smoke in the market. And so what we're looking for then is we're going to start looking at other dimensions. All right. So another dimension, which is basically another set of patterns, we're on top of that. We're going to be looking at what we call pairing patterns. So that's going to give me the direction of influence. So if I see the market's trying to push lower, excuse me, and I see that I'm having a setup pattern, I'm starting to see a little bit of smoke here that, hey, it looks like it's wanting to push even further down, then these two dimensions are going to give me a stronger indication that the market's going to come down. But then we want to throw in two more dimensions. I want to look at the EOM pattern. So this is direction resistance. So market's going down. We see direction of influence is pushing down, but are we going to run into a lot of buyers or sellers? Are we going to run into resistance, right? We're trying to get out of that building. Is the door going to be locked? Or is it going to be wide open so we can get out of there? So we're looking at that resistance of, if we're going to take a short, I don't want to see a big steel door there if I'm going to get out of the building. I want a nice door that's going to be open. I can get out really quick. So once again, we're looking at that direction of resistance. Then finally, and this is a big one that a lot of people overlook, this is market correlations. So we're looking at, how does a particular market that I'm trading, how does it correlate with another market? So there is a relationship, say, between crude oil and gold, or there's a relationship between a particular stock and its sector of stocks. Currencies all have correlations, and when I say correlations, I mean that if one particular currency is going up, right, like the euro, then I would expect, say, maybe the Aussie to be going up as well, right? So the Aussie US or the Euro US, and if they all move in the same direction, that's going to be a positive correlation. And then if for some reason maybe the Aussie goes up and the Euro goes down, let's say that's been a relationship that's been pretty true historically, then if Aussie is, say, going up, then Euro's probably going to come down because it has a negative correlation. So we're looking at what has positive and negative correlations for all the markets that we trade. So whether it be a stock or whatever, everything has a correlation of some sort. We want to find those because that's going to also give us a good indication. So if for some reason you say that all this adds up to a short, and I look at this and I say, okay, well, the euro's coming down, but I also know that when the euro comes down, let's say the yen also comes down. Well, if the yen's starting to come down as well, then it kind of gives me a little more confidence that the euro's going to come down, because that relationship, I know they tend to move together. That's going to give me another layer or another dimension of looking at the market, saying that I have a higher probability. So all we're doing here is, when we look at each one of these patterns, is each one of these patterns can hold up on their own. They all are effective on their own. And okay, so if they weren't, it wouldn't make any sense. So if the pairing pattern didn't work by itself, the EOM pattern didn't work by itself, if the first dimension pattern didn't work by itself, market correlations didn't work by themselves, they wouldn't be effective, right? But since they all work by themselves, then we can stack them. Remember, indicators we can't stack, because if an indicator doesn't work, stack another indicator on top of it, right? It's like putting that dead spark plug in that engine. Okay, it's not going to make the engine run better. So each one of these can be used and traded on their own. You don't have to stack them, all right? And based on your level of experience, sometimes I may only look at two dimensions. As you become better and better at it, you're going to get a good feel for the market. But as a new trader, you want to wait for these four dimensions to line up to give you the highest probability of being on the right side of the market. Okay, so when you combine the four dimensions, you see a more holistic perspective into the present influence on price movement and the greater forces that are pressing the direction of where prices want to go. This is expressed very much like a hologram. Price movement is expressed like a hologram. Okay, so I know it's getting kind of crazy here, but bear with me here, because this is just an analogy. The markets are very much like a hologram. If you go to my website, I wrote an article back in 1989 where I was looking at the crude oil, and I was using this approach, and I talked about the markets being very much like a hologram. And we were predicting prices on crude oil, and I provided it to the magazine, and it was a month out projection. And sure enough, it hit that week right on the money, and crude oil took a turn. So I know that the markets are very much like a hologram. So I want to talk a little bit more about that, so it makes a little bit more sense why the market is kind of like a hologram, right? Some people say the universe is a hologram. Maybe it is, maybe it's not. But when it comes to the markets, right, it is like a hologram, and let me show you exactly why that is. And this will make a lot more sense. So first of all, let's talk about how a hologram is constructed. Bear with me, because this is all going to start to make sense when you understand how holograms are designed, and then we'll see how does that affect the markets, and how is it very similar to a hologram. Holograms are made by using a single laser beam, okay? So basically what they're doing is the beam is then split into two beams by a special lens. So basically in the lab, they have these two lenses, they have this laser beam, typically a couple laser beams, and they're shooting through these lenses. And these lenses are like refract. They reflect the wave off, or the laser off, the laser beam off, towards a particular object. So that way, when you get two laser beams that are exactly the same, all right? So the beam is then split into two beams by a special lens. That way you get two laser beams that are exactly the same. One of those beams is what we call the reference beam, and is shown directly onto a special film. The second beam is reflected off of the object that you want to make a hologram of. Okay, now I'm going to show you an image here, so this makes a lot more sense. This may not make sense yet, but you'll see here when I show you the images, all right? So we've all seen holograms. You wondered, how can they make those things three-dimensional? This is how they do it, okay, and how this is going to be very similar to the markets. When the two laser beams intersect, they create what is called an interference pattern. This is the pattern that the two sets of waves make when they overlap. When the two sets of waves run into each other, they form a pattern. That pattern is what's recorded onto the film. Then when the film is developed, you can see the whole image by only shining the reference beam. So basically what the plate is doing, it's recording the different angles of reflection off of the object, okay? Because the beams, when the laser hits the object, it's going to bounce off of it in different directions, and that's captured by the special plate. And that's what allows us to go in and look at a hologram in 3 dimensions, because it's just basically recording that light refraction. And so basically this is what it is. So you've got this, let's say this is just a simple apple. You got this laser beam here, you got these two glass lenses, you have a lens here, and you have these, they reflect off of this, so that's going to hit this lens here, it's going to hit this lens here, and then what it's going to do is going to come over here, and it's going to hit the, it's going to go straight right, it's going to reflect straight onto the plate, where this one is going to be reflected off, and it's going to start creating different angles, okay, of this object. So, and then these two beams right here interact with each other, and then they hit on the metal, they hit on this special photographic plate, and they're recorded there. So once they have the refraction, that angle of refraction for each one of these beams here of light are recorded on the plate. Okay, and so what you have here then is you have this holographic plate. So when you take a look at this plate and you look through the plate, what do you see? You see the whole apple, right? You don't see a one-dimensional apple like you see here. You're going to see a three-dimensional apple, right? You've seen them. They have them on credit cards. You get them on everything these days with holograms. But that's how a hologram is made, all right? Well, what's really interesting is that a price chart, okay, is very similar to a hologram, all right? Let me show you why, and it's really cool. Okay, so what's a unique characteristic of a photographic plate? Well, if the holographic glass plate is shattered, the whole picture can be seen in each piece. So let's go back. That's kind of cool, right? So this is a glass plate, all right? It's a solid, but let's say that I dropped this on the floor and it shattered into little pieces. If you picked up one of those little pieces, you're not going to see just a partial part of the apple. You're going to see the whole apple again. So every little piece is going to be a reflection of the whole apple, not just a part of the apple. Because remember, these beams are being recorded throughout this plate, right? It's not just a single beam here and a single beam there. The angle, each one of those are a combination and recorded on the plate, throughout the plate. So each piece is going to reflect the whole. You don't need the whole plate to see the whole. Just all you need is a piece of it to see the whole. People say it's very similar to fractals, very similar to a fractal. Okay. So what are the characteristics of the four dimensions? Well, once again, like a hologram, like a holographic plate, when we view market movement through the four dimensions, we can see the predicted price direction in all time frames, just like we can in a hologram. That's why these patterns are so cool, because these patterns, when you overlay the patterns on top of each other, right, it forms that hologram. So I can use them on different time frames. So how many indicators can you do that? I mean, that's the beauty of looking at patterns, is because I can take these patterns and I can look at a daily chart, I can look at a 5-minute chart, I can look at a 15-minute chart, overlay these four patterns, and it's going to show me direction no matter what time frame I'm looking at, just like you can with a hologram. Where you look at that individual broken piece, you see the whole. It's the same thing when you understand and know how to use and look at these four dimensions. But you have to understand what the four dimensions are. Okay, so this is one of the patterns. We have different, we teach 5 different patterns in the core package, kind of the foundation course. And this is called PAP. Now, this is when I started my service, okay, back in, I've been using these patterns for a long time, but for, I had it to do in the market, real time, in our live chat room, tracking every single one, verified by all our students, from 8/19 to 2019 to 12/31 to 2021. Why did I quit? Because I just got too inundated to keep up with it, all right? It's a tedious job. But we tracked, I was looking at 4 different currency pairs. We were looking at just this one pattern, the very first dimension, all right? When you look at those 4 pairs, just one dimension, that was 9 hours per day. So I was tracking it for 9 hours every day, all right? Talking about tedious. And I still have that spreadsheet today. If any member wants to see it, I can show you that spreadsheet where I tracked it every single day. And we would talk about this, and I would share this spreadsheet, in our live room so you can see it for yourself. But that's over 9 hours a day. So that had a total set of just this one pattern. Remember, I teach you 5. One pattern had a total of 41,404. By now, it's well over 50,000, I'm sure. Winning percentage, 73%. That is crazy, okay? So most people be happy with 60%. That puts the odds in your favor, right? You go to Vegas, if you have a 2% odds, they're going to throw you at a casino. But, 73% over 41,000, that's pretty convincing, all right? The power of these patterns and the reliability of these patterns. I would certainly want to trade a PAP pattern over anything else because I know the reliability of it. And I'd say 41,000 examples. That's a lot of examples, and if it's not going to hold up, you're going to see it not hold up. But 73% is pretty strong. So, and that's just PAP. We do have others, and they're all going to provide you with the same percentages, somewhere between that 70 to I think 76% is what I saw. Okay, so these are kind of, once again, just kind of examples here. This is going to be a 1 year and a 5-minute chart here. So same market, 1 year, 5 minutes, 1 year, 5 minutes, and basically at the using the exact same pattern. Okay, so no difference on a daily, no difference on a 5-minute. You can see this is where the indicators came in to be a buyer or seller on the next bar, So you can see here, if you look at this, you see this little S under this little red caret. It says be a seller on the next bar, meaning that it's predicting that the market's gonna come down. It's gonna be a red bar the following bar. Okay. Here's a buy. Didn't quite make it, but once again, we're looking at 2%. So once again, not every single one's gonna hit. Here's one, a red bar. You can see that it hit. Here's going down to the 5 minutes. There's going to be a green bar. It hit. Next one says it's going to be a red bar. It hit. Over here it shows it's going to be a green bar. It hit. And we can go on and on with the other chart as well. So same pattern, right? Just use it on different time frames. This is stocks. We're looking at Tesla, and I think this is what, AMC, same thing. You have dailies, 5 minutes, same thing. Same thing with stocks. Same pattern that I used on the other two charts. I think the other one was crude oil. Okay, so let's talk about the crystal ball. Now, after you understand what core is and you understand the basics, because everything is going to be based off of the fund, it's going to be based off of the base, or what I call the core. From then we start moving into the crystal ball, okay, which is basically what I call the fifth dimension. Now, I do a lot of my personal trading with crystal ball, because the nice thing about the crystal ball and the fifth dimension is it predicts price, direction, and magnitude. So not only is it giving me direction, but it's giving me, more importantly, magnitude. Okay, here's some examples of the market when it typically will give me a prediction. It could be anywhere from 30 seconds. Sometimes I've seen it be 2 or 3 minutes early. Okay, and not only that, it gives me indication of the size of the move. Okay, so these are actual setups here, and this is most recent. I think this was back on. This is back middle of July, I think, of 2022. So we had indication that the market was going to pull down. This gave us like, this was like a 2-minute warning. This is a 1-minute chart, by the way. And this gave me like 2 minutes warning that we're going to have a down move. And then it turned around and said, gave me a warning right on that bar that we're going to have an up move. Sometimes it gives us early, sometimes it's right on the bar. This gave us about a minute and a half early warning that we're going to have a down move. But not only that, is when it's giving us indication up or down, it gives me indication of the size of the move. It's going to be a big move or down move. Why is that important? Because if I'm going to sell, particularly if, let's say that I want to use an option, say I'm an option trader, I want to do it deep out of the money. I'm not going to want to move that's going to be small. I'm going to want to move that's going to be larger. So I'm going to wait for those indications that we're going to have a bigger move. So the crystal ball is really strong because not only gives early warning, but it also gives us magnitude. So small moves I stay out of. I look for big moves. Big moves I like to trade. Big moves mean what? More dollars. And then finally, I want to talk about Einstein. Now, Einstein is a formula that I did not conceive. This was conceived by a trader back in the late 80s. It was shared with me, and I've certainly made some modifications to it. It's a little bit different, and when I do my training in Einstein, I have a good 3-hour video where I just go into Einstein, go through all the examples, and give you a little history on Einstein and all that good stuff. But basically, let me tell you what Einstein is, because Einstein really is a formula that's and it's a method, and that the way that I use it in combination with my pattern. So the name Einstein formula was a mathematical formula and method conceived by a very successful private day trader back in the 1980s. Okay, his search was to find a way to predict both price direction and price levels within any market at a high predictable success rate. What he found during his research was that all market prices move in waves, and that each wave size would reflect the same wave size again sometime in the future. So basically, if you have a price move, let's say you go back and you look at the last wave, and let's say it was say in a stock, maybe it was a $5 move in stock. Well, that same $5 move in the stock going up is also going to it's going to reflect and refract back, okay, to another $5 move down sometime in the future. All right, and that's basically what he's talking about here. So, for example, if we have a stock that went up from 10 to 11, that would be a price wave size of $1, right? This $1 price wave would once again reflect itself at some point into the future. The Einstein method is designed to identify when these wave reflections will take place and the direction of the price move. Sometimes, but not often, there will be a wave inversion where the projected direction will reverse. The probability of hitting the predetermined price level before a wave inversion is somewhere between 72 and 8%. Folks, that's across the board. Okay, stocks, commodities, you name it, everything, cryptos, it's going to be the same for everything. Okay, and that is something when we teach you the Einstein formula, we go back and we look at examples. and then we encourage you to go back and use your own stocks or commodities, or if you're trading forex, whatever the case may be, and you'll be able to see Einstein, how well it works in predicting these types of price moves, not only direction but levels, okay, with this type of accuracy. It's just incredible. So this, once again, this method can be applied to any freely traded markets, such as stocks, commodities, forex, or cryptos. Okay, so let's look at an example what this looks like. And this is going to be, once again, this is the most recent example where, and this was during my live show, and most of you, I'm sure, are here because of the live show. But on this particular day, this was Tesla, and we were looking for a $5 move. We entered at 8:39. I predicted that the Tesla was going to have a $5 move. And at 8:50, it did have its $5 move, so it hit its objective. All right. And then again, let's see here. Let's go to the next one. Okay, this is the ES. This is the E-mini S&P 500. Okay. So looking for a projected price at 1023, we are at 39.84 and a half. We projected down to 39.72. This entry came in at 10:33 a.m. and it completed at 10:37, and it did hit its projected price. So when I'm using Einstein, that's exactly what I'm doing. And once again, this is a real-time example of what we did trade on this particular day. This was back on July 22nd, and we made these calls. I do this every morning, folks. So if you're part of the live show, you're watching the live show, this is what I'm providing, so you can watch how well these levels hit. All right. Now, I talked about reversals. Yeah, you are about 30% of the time. Instead of it coming down, it may reflect back up, and then this move here is going to be reflected back up to the upside. It's like I said, it's only happens about 30% of the time, a little bit less than that. So high probabilities that these trades, I'm going to hit my price levels. So the question is, do you think that would be something that you can use, whether you use my methods or use your own methods, knowing that, okay, in advance? Do you think that would give you an advantage in your trading? I would imagine it would. It has for me. So I'm sure that if you're using it, I'm sure you're going to find it that it's going to give you a huge edge that most people don't have, because they don't see the market in this way. Here's an example of gold. Once again, a real-time example. Entered at 833, coming in 1700, projected $4 move on gold. Exited at 841. So from 833, about 8 minutes later, 841, it hit its price level. Bam, bam, and off you go, and you get out and you hit that level. Now, it will continue to project higher levels, but the probabilities go down. We don't get into all that. I like to trade just the first level because that's my highest probability. But if you're a trader that likes to, follow the market, the action, you think it's strong, it will provide you with additional levels. All right, so if you're interested in learning about my package, or learning this way of trading, we offer 3 packages. We have the silver package. Basically, it's a foundation course where I'm going to go through and I'm going to teach you those 4 different patterns. You're also going to get 3 full months access, okay, to all the training videos and educational material. You're going to have access to our live trading room, and it's open in the morning and in the evening, okay? So open most all day. So you get full 3 months of that to not only watch and learn, but also to watch it live, ask questions. So we're giving you a lot of time for y'all to learn these patterns and become proficient at them, because this is going to be the basis of everything, is understanding these patterns. We'll teach you how to adjust contract size for maximum profit. So when I go in, when do I want to hit a little bit heavier than not? Talk about that. And then a lot of you, as always, any beginning trader, and even if you're not a beginning trader, anytime you're trading a new method or strategy, you never trade live. Don't just jump in there live. Always want to start with a simulated account, simulator, or a demo account, they call it. Do that first, and then when you're ready to go live, we do have some videos out there that will kind of help you make that transition, all right? So you don't just want to jump in going from, trading a simulator to jumping into a live account. because a lot of people don't trade a simulator like they do a live account. So there's a couple things to be aware of and some things to be careful of before you make that transition. All right, and of course, I'm in there every morning from 10 to a.m. and Eastern time, so I'm there to answer your questions. Obviously, I do the morning show, and then I stick around another hour in the live room to continue to answer people's questions, and if I see setups, I'll call out those setups as well. Then we go to the gold package. Now, the gold package includes everything that you see in the silver package, but we added some additional things. You're going to get 6 full months, and you're also going to get, and this is going to be the same with the silver, you're going to get our daily setup. So those are an email that goes out every evening, and what it does, it provides us with a trade that you put on the night before, and you just let it expire the following day, or just get out the following day. So you want to do it right before the market closes if you're a commodity trader. So we'll provide you, or Forex, we'll provide you with those setups, whether they're long or short. Show you, I give you an idea where I'm getting in at, because I'll give you some levels to get in, and then we just pretty much let them just follow through to the next day. All right, so those go to everybody. Those are sent out every night. You're going to have access to exclusive trading hours. So we do have once a week, we have a night where all we do is we focus on working with Crystal Ball, because remember, Crystal Ball comes with this package here. So gold package is going to include Crystal Ball, so we're going to be looking at Crystal Ball and really getting into that 5th dimension on how to use Crystal Ball. All right, and then we're going to also show you some additional patterns, call them HF 1, 2, and 3, and how you can use those with the Crystal Ball and really start to take advantage of some of these really nice moves that come in the market. So going to throw in some additional patterns there for you. And then finally on Platinum, that's when we includes everything. If you want to take advantage of everything all at the same time, we're going to get into Einstein too. Okay, so everything from silver, everything from gold, and then we're going to throw in Einstein. And like I said, a good 3-hour video where I go through it all. I go through showing you examples. We have testimonials of people that have been using it. Even during the live broadcast, people provided me with stocks they wanted me to look at. We looked at them, and we went back historically, and the proof is when you see it on the charts, and we provided that. So so good 3-hour video goes through in depth into Einstein, how to apply it, how I trade it, and the best patterns that I use with Einstein, because I do incorporate patterns with Einstein. Once again, make sure you watch our live demonstration every morning. I'm there every morning for an hour, absolutely free. So I'm going to demonstrate these methods. So if you have any questions, seeing is believing. So the best way to see whether something's going to be work for you and help you in your trading is to come join me every morning live. I'm going to be there 9 a.m. to 10 a.m. Eastern time every day on YouTube and Facebook. So Monday through Friday. And I will call these out, and also invite you, if during the broadcast, if there's something you want, there's a chat window, say, hey Ken, I'd like to take a look at Apple stock. What does Apple look like? Or what does Netflix look like? And I'll be glad to look at those for you. So, I do usually have about 10 different markets I'm looking at, good variety. So we have some Forex stocks, we have some indices, some commodities, with the idea that to demonstrate this method, all right, but to demonstrate it live, that you can see that what I'm saying does actually work in the market, right? And it is superior to indicators, and I will show you that every single morning. So the proof is for you to see it live, okay? So if you have any questions, the best way to contact me is contact@innovatortradingstrategies.com. I do answer all my emails, and always be glad to chat with you or answer your questions. If you have questions about these packages, each one of the packages, if you decide to get just one package, like say you start off with silver, you will be able to upgrade. You don't pay full price for gold. If you already bought silver, there's going to be just a one-time upgrade cost to go up to gold, and then if you're gold, same thing, going up to platinum. So If you start with silver, you just want to do silver, and you decide to upgrade down the road, you don't have to pay the full price for gold and silver. There's a discount there, so we give you that, so you can upgrade as well. All right, so that's going to be it. Once again, thank you all for joining us. I wanted to make sure that everybody had just kind of a basic idea of what I'm doing, because I know you look at my charts, you don't see anything there, so hopefully this makes a little bit more sense. And if you are joining us live, maybe you have some questions. I can't answer all my questions if I get busy, but if I can't, my moderator will. And make sure you join us every morning. I'm there every morning live. All right. Thanks for joining us. I appreciate it. Any questions, let me know. And you have a good trading day. And hopefully we'll see you in our live room here either tomorrow or the following day. Take care.